irredeemable, there is a formula available to you. So the irredeemable information is quite important. It's a permanent finance source with a market price of 88 euro. But watch the price. It's cumulative of interest. So they're saying it's 88 euro, but that includes an interest payment. When you see the words cumulative of interest or cumulative of dividend, it means there's a dividend inside the price or interest is in the price. It's about to be paid out. The coupon rate is 8%. So these are 8% and the nominal value is always 100. So you see, I know the interest there. 8% of the nominal, it will be the interest. So I'd be able to figure out the interest. It's the same as the preference share dividend. The interest is a percentage of the nominal, 8% of a euro. So 8 euros would be the actual interest payment. If you get what's called an irredeemable debenture at the back of your exam paper, you'll see a formula which tells you how to calculate the cost to the company. And it's interest. That's the amount of money they pay by 1 minus the tax rate, because interest is tax deductible, divided by the market price X, in this case, dividend. Now, you see, when you get all of these information pieces, your problem is just to calculate the cost of the equity, the cost of the preference share, and the cost of the debenture. So I'm just showing you on the document camera how it's done. That, you know, what happens with sometimes in exams, people mix all this information up and they don't keep it compartmentalized. If you keep it compartmentalized and you have the formulas, you'll have no problem with the calculation. So I'm going to bring you to the overhead now and show you how to calculate this. But I hope you have an idea of the way in which, you know, the kind of stuff you're looking for here. For ordinary shares, you need the number of shares, bit on price and dividend growth. Preference shares, number of shares, bit on dividend and price. There's no growth in preference. And for debentures, you need to know the actual percentage, the interest rate, and you need to know the amount they borrowed, that kind of thing, and the tax rate. Okay, so let me show you what the solution would look like if I bring you to the overhead that we had a few minutes ago. What I've drawn out for you there is just the kind of stuff that you get from the question. Let me show you the actual solution to the question now. In this question, you have to calculate the cost of equity, the cost of the preference shares, and the cost of the debentures. Now, I know you'll see at the bottom of the question on the page there, it talks about calculate the market value of each source of capital. I'll put it up in red there. That's the thing we're going to do today. Just make sure you know how to work out how much are we talking in ordinary shares, preference shares, and debentures. It's called the weight or the market value or the amount of each source of finance. I'll come to that in a few minutes. But let me show you anyway how to work this thing if I show it to you on the next overhead. First of all, cost of equity. I hope we were okay with this. You may have done this question from last week. You would have seen it up on Moodle anyway. It was available to you. But the story is simple. Find next year's dividend for equity, put it over the price and add the growth. So I did it in cent format on the overhead. So what am I doing here? I'm just figuring out, well, I know the current dividend is 7 cents, but it'll grow. Next year, it'll be a little bit higher, about 7.5 cents. Put that over the price and add on the growth rate. This is a formula that's available in the exam. You'll generate an answer about 23 or 24%, and around 23%. Keep in the back of your mind what it's about. The company is paying dividends to keep these shareholders happy. So it's never costing them money. You're just comparing it to the price. And in ratio terms, it's about 23% or something. Now, the growth factor is quite important. It does increase the cost dramatically. When you look at the preference share, again, there's a formula, dividend over price. I've explained how to get to the dividend. It's 7.5% of 50 cents, so 3.75 cents. That's the hard part. Can you find the dividend, put it over the price? You get a decimal answer, you transfer it to a percentage, and you'll have a cost. They're paying 3.75 cents every year to keep these guys happy. They could always buy the share on the stock exchange for 32. So the ratio is the price, the cost. The last one I'll be very careful with, because when you're using irredeemable debenture formula, and it will be available to you in the exam, you need to be familiar with the actual price X interest. Now, in the question, you were told the price, including the interest, was 88 euro. But I know the interest is 8%. Interest rate is 8%, always of 100. So take your 8% of 100, which is 8 euro, take it away from 88, and you'll have the price X interest. That represents the price X interest. It's 80, not 88. That includes the interest. Take it away, you have the price without the interest. And then you have the simple application of the formula. And how you work the formula is you simply look it up on the back of your exam paper. Interest by 1 minus t over price. Interest, €8, 1 minus t. That's a decimal, 12.5%, 0.125. You get about 7 over 80, 0.0875, 8.75%. So that's really what was involved for this question. It was the easiest of the three questions on that page you have here. But what's important to understand is that companies don't just use one form of finance, they use a mixture. That's the idea. So what I'm going to do now is introduce you to the concept of market valuation. I'm going to show you a new overhead. It's already up on Moodle, but the routine here is when I identify the various costs, I need to figure out how much of the company is financed by each source. What I mean by that is, what are we talking in terms of ordinary shares or preference shares or bank loans or debenture issues? What is the amount that the company has outstanding at the moment? So this is what's called market valuations. Now I'll show it to you on the next overhead, how you calculate these things, and I'll come back to the actual physical calculation. So when you're looking at what's called the amount of each source of finance, we actually work it on the basis of what's called market value, or they're also known as the weights. What's the weight of the equity? What's the actual amount of the equity? I do this for every form of finance. And there are only five that you need to be familiar with effectively. But for equity or ordinary shares or preference shares, it's really simple. You've got to figure out how many shares are in the company and what's the current share price. If you multiply those two numbers, you know the value of all of the shares or the preference shares. So that's basically a routine. You haven't seen this before. I'll bring you back to the question a few minutes ago that we were looking at, and I'll show you how to do this. But that's how you calculate the value of all of shares, whether you have ordinary shares or preference shares. Your problem is simply to figure out the number of shares and multiply by the share price. It's as if you were buying all the shares. What's the amount in value terms? So no problem with that one, I imagine. Just figure out the number of shares multiplied by the share price, and you have the value of all the shares, whether it's ordinary or preference. If, however, you're looking at what's called the debenture value, and you've seen what are called irredeemable and redeemable debentures. So if you're trying to figure out the value of the debenture, it's different. You don't have to work out the number of debentures and multiply it by the price. You can do that if you want. But usually what you do is you look at what did they borrow? It's in the balance sheet. So you take the old balance sheet figure and you multiply it by what's its current price versus 100, or price over 100. So this is something you need to kind of remember. It's an easy way of doing it, and I'll show you with an example in a second. But you just simply take what did the company actually borrow originally? That's in the balance sheet, the amount they borrowed, and multiply it by its current trading price over 100, because the nominal value is always 100. The trading price might be 60 or 70 or 80 or 110 or 120. You just have to make an adjustment to the balance sheet. And I'll show you that with an example in a second. And the third possibility for you, again, you have different types of shares, different types of debentures, but if you take a loan from a bank and you borrow from a bank, you're effectively not something that's trading is happening here. You just take the size of the loan. So if I say to you the company borrowed 5 million from a bank, that's the actual amount. It's 5 million. The assumption here is the company will pay back what it borrowed to the bank. So if you see a 2 million loan, the weight or the value is 2 million. It's not something that trades on the stock exchange, whereas the ordinary shares, preference shares, and debentures, they all trade on the stock exchange. The other guys don't. So let me show you this with the previous question. The question that you have there, what called half a scissors, right? You'll see it in your notes there on page 11. So I go back to that question and I'll show you how to work the market valuations of each form of finance. If you're looking at the question on page 11, what do we have for ordinary shares? I wrote it down a minute ago. There were 1 million ordinary shares and the price of the share was 49 cents. So if I want to work out the market value of the equity, your man up here, how many shares were in the company? 1 million. What's the share price? 49 cents. Just simply take the number of shares and multiply it by the actual value or price of the share. So for the ordinary shares, 1 million, that's one with 6 zeros. And I don't put the price in cent because I want the answer in euros. So 49 cent is 0.49 of a euro. It's the same as the price up here, except I'm transferring it to euro form, 0.49. With an old calculator, if you work that, you get 490,000. What does it represent? It's the market value of all of the shares at the moment. If you wanted to buy all the shares, there's a million of them out there and they're 49 cent each. So if you wanted to buy the whole lot, it'd be about 490,000 euros worth of shares out there. You do the same crack for the preference shares. If you're looking at page 11 and looking at question 3 and you look at the number of preference shares in the company, there are 250,000 preference shares and the share price trading today is 32 cent. So same old crack. Take your 250,000 and multiply it by the price. Now, not in cent, you want the answer in euros. So 0.32 is the same as the price up here. That was 32 cent, but in euro format, that's 0.32. If you use a calculator and multiply 0.32 by 250,000, you'll get something like 80,000. Again, it represents the value of all of the preference shares, their current market valuation. And the last guy was the debenture. Be very careful with this one. How much did they borrow? If you look at the question, you'll look at question 3, you'll see the debentures. They borrowed 100,000 euro from the general public, but it's trading at, now it's not trading at 88, it's trading at 80x interest. So there's the value. You just put that over 100 and multiply by the 100,000. So that's a bit different now. So the debentures, what's the balance sheet figure? How much did they borrow? 100,000. What's it trading at? 80 euro, or if you like, 80% of the original. It's like if the company wanted to buy back its debt and cancel its debt, it wouldn't have to hand over 100 grand, it'd just hand over 80,000. That'll buy all the debentures out there on the stock exchange. So that's the market valuation. So what you'll see in a question when we actually get to the final stage of the process, you need to be comfortable with calculating the cost of every individual source of finance, but you also need to identify what's called the weight or the amount, how much of the company is financed by each source. So if you move to page 12 in your handout and you look at the very top of the page, we hit the final stage in the process. On the very top of page 12, you'll see a heading, weighted average cost of capital. Let me show you what's happening here. So if you go to the top of your page 12, you'll see this heading. And the idea behind this is we need to come up with one number at the very end so that the company knows the cost of all the different sources of finance. So this last character here is called the WACC. Now, I said at the very beginning of the course, there's a 3-step process in how to calculate this thing. You look at the capital structure of the company, and number 1, you calculate the cost of each individual source of finance. For you, that would mean if you find ordinary shares in the company, get the cost. Same thing for preference shares. Same thing for a bank loan. Same thing for a debenture. It's irredeemable or redeemable. So you have different possibilities here, but you will never find a company has just one source of finance. It will have a mixture of different formats. So the first thing to do is to get the cost of each one, like you've done in the last 3 questions. Get the cost of each of the individual sources of finance. The second step in the process is you need to figure out how much of the company is financed by each source. What is the proportion or weight attached to each source? That's what's new and what you've seen today. So the next thing would be, if you find shares, get to value them all. If you see a loan, identify the size of the loan, etc. So weight each source by market value, always market value, current trading price. And this is the final step, which we're about to show you now. You need to work out one answer at the end. So work out what's called a weighted average. That's the final step in the process. Get a weighted average. So what I've done in your notes, if you're looking at page 12 here, you'll see the template for how it's done. And I have a little example. So I just made up an example for the crack, right? So a bit like the last question. Suppose you looked at a company and you looked at its balance sheet or statement of financial position, and you found that there were 3 forms of finance in this company. The company got money in from various investors. It had people who bought shares in the company, ordinary shares. They're the owners of the company, the equity. It also issued preference shares so that it got people who wanted to get a fixed dividend every year. and it issued debentures in that it borrowed from the public on which it has to pay interest every year. So suppose you have three forms of finance. And the purpose of this little question is to show you how do you work out a weighted average. So again, I'm making up the numbers here for the crack, right? And you'll see this in your notes. So suppose you found the cost of the equity, whatever it was, 15%. Preference shares at around 8 and the debt at 6. You'll see this right in the middle of page 12. So I'm making up these numbers. You understand, to get the old 15%, you might have to work out dividend growth, dividend per share, price of the share, ex-dividend, and you worked out an out score of 15%. This is the same crack for the other guys. So I have three answers. The thing about what's called a weighted average is you can't just add those three numbers up and divide by 3. It's not a simple average, it's a weighted average. So step 2 kicks in here then. So once you've got the cost of each one, like you've done it already, I then have to figure out the weight of each one. So what's the weight? I'm making these up now. Suppose for the crack, you found there was a bunch of shares in the company and they had share prices available and you multiply them, you got 5 million. So this is a weight I'm suggesting. Suppose you got 5 million of equity, 1 million of preference share format and 2 million of debt. Now these are what are called the market value weights. These are what are called the actual amount of equity, the amount of preference shares, and the amount of debt based on current market prices. And then this is how you'll see it in your notes here. How do you work out the average? Before you get the answer, I'd be very careful. The highest cost is 15, the lowest cost is 6. So obviously if I'm getting the average, it has to be between the 15 and the 6. So in case you get a mad answer, like, you know, your answer has to be between 15 and 6. But how you do it is like this. You simply take the weight for the equity, 5 million, and multiply by 15%. You take the weight for the preference, multiply by 8, and the weight for the debt, 2 million, multiply by 6. And then you add them up and divide by the sum of the weights. What you're doing here is working out an arithmetic mean, just a central tendency point based on these weights, and these are the costs. If you think of these like frequency distributions, and these are actual costs. Okay, so this is what it looks like, and you'll see this in your notes. Now, my advice to you when you're doing this in a situation in an exam, at the very end, when you're working out the weighted average, just treat them like numbers and forget the old millions and the euros and the percentages. Just 5 by 15. The weight is 5, the cost is 15. 1 by 8, 5 by 15, 75, 1 by 8, you're at 83, and 2 by 6, you're like at 95 or something. And divide by 8, that's the sum of the weights, and you'll end up with an answer. Now, what's critical is the interpretation of the answer. The answer we have at the end here, obviously it's what's called a weighted average cost of capital. It represents the cost of all the different sources of finance. But more importantly, from the company's point of view, it indicates something very important to the company. It indicates or represents what's called the company's minimum target rate of return. So when this company invests, when it decides to go for any investment situation, it has to at least achieve about 12% return on the investment. So the reason companies like to calculate what's called the cost of capital is that they know what their target rate of return on investment is, and then they can make good decisions about what are good investments and bad investments. So this is a very fundamental piece of information for a corporate. That it's like if you borrow from the bank and you just take an old bank loan, it's charging you 10%. Whatever you invest in, you better make 10%. If you make more, brilliant. If you make less, you're in trouble because you won't have enough money to pay back the bank, including the interest. So this is the idea. You're working out the weighted average cost of capital, and it represents the company's minimum target rate of return. So you'll see directly underneath that, what I'm going to do is I'll do one more little question on calculating an average, and then I'm going to give you a question. And then we'll take a little break, and then we'll get to exam style questions.
So where did you get the 8 million under?
No problem. The 8 million underneath here is simply the sum of the weights. It's the 5 plus the 1 plus the 2. So if you add 5 and 1 and 2, you'll get that score of 8 million. Is that okay?
That's perfect. Thank you.
Perfect. Yeah. So this is just like an ordinary arithmetic mean. It's like you have, if you like, frequency by cost all the way across, and the sum of the frequencies underneath, or the sum of the weights. That's all it is. The sum of the weights. Okay. So I'll show you the next little example of this, and you'll see this in your notes, and I'll explain what's happening with this question. And what I'm going to do, I'm going to go through this kind of slowly, And then I'll ask you, I'll put a poll question up for you. I'll give you 5 or 10 minutes. We'll take a break then and see how you're getting on. But we're almost at the very end of the major topic for me on this course. And it's all about trying to figure out what is an appropriate target rate of return for a company when it's doing an investment. So the final thing you'll see here is another example. It's in the middle of page 12, halfway down the page. And I'm making up these numbers. I'm saying, suppose you went through a whole question. You found there were 10 million shares in the company. You found the share price was €2 on the stock exchange. And you're told, suppose you got your cost of equity at 6%. Same crack for preference shares. I got 2 million shares. I know the share price, and I actually know the cost of the preference share, 6%. I have one more form of finance. It's an old bank loan, and it's a 4 million bank loan. It's at a 5% interest rate. Shouldn't be a comma there, but anyway, a 5% interest rate. And the tax rate is 20%. The question that's posed here is calculate the WACC. Now, the point is this. I have more or less everything. I have the cost of the equity. I've got the cost of the preference share, but I have the pre-tax cost of the loan. I know the bank is charging 5% interest rate, but interest is tax deductible. So there's one little piece, red number, missing here. I don't know the actual cost of the loan, but if you remember, if you ever get a bank loan in a question, and we did this a while ago, a couple of weeks ago, all you got to do is take the interest rate on the bank loan and multiply it by 1 minus the tax rate. So if the company is paying 5% interest on the bank loan, take that 5% and multiply it by 1 minus the tax rate. Now I'm using a 20% tax rate here. You put that in decimal, that'll be a 0.2. So you'll get zero point 0.2 for the tax. 1 minus 0.2 with the calculator will generate an answer of 0.8 by 5 will give you 4. So what have I done? I just had one little thing to do, and that was to adjust the bank loan. The cost before tax is 5%. That's the actual interest rate charged. But after tax, that's the effective cost to the company. Now you got your three red numbers, 10, 6, and 4. So when I'm working out the weighted average cost of capital here, it has to be between the 4 and the 10. Somewhere between the 4, 6, and 10. It's somewhere in the middle of those guys. So what I just showed you a second ago is what you need is the weights. The first thing is to get the cost of each form of finance. That's step one. Second thing is the weights. So how do you get the weights? It's pretty easy. For ordinary shares, you just take the number of shares and you multiply by the share price. And you'll see this in your notes done for you. So if you take 10 million by €2, you're going to get 20 million valuation for the shares. That's what's called the weight in this thing called the weighted average. So that's the amount of equity. Same old crack for your man here, preference shares. I got 2 million preference shares. They're trading at €1 each. So 2 million by €1, and you'll get an answer for that guy. Now watch the bank loan. As I showed you a few minutes ago, bank loans don't trade on the stock exchange. They don't have a trading price as such. They're not like debentures or shares. So what you got to do is just take the size of the loan. So if they borrowed 4 million, that would be the weight. The bank, you owe the bank 4 million. It's assumed that you'll pay back the 4 million you borrowed. So what have I got now? I have the cost of equity, cost of preference, cost of debenture. I got the value of equity, value of preference, value of debenture. So the final step, you'll see it in your notes there, how it's done. Essentially what you do is you take 20, you multiply it by the 10. You take the L2 for the preference, multiply it by the 6, and take 4 for, in this case, the loan, and multiply it by the 4 after tax cost. So these are the numbers on top, 20 by 10. Again, I would, I'm putting in the full format here, but I'd ignore the euro and the millions. It's just 20 is the weight, 10 is the cost. That's 200, 2 by 6, 212, 4 by 4, 212 and 16, 228 or something. Below the line, just as the question a minute ago was asking, is the sum of the weights, 20 and 2 and 4. That's 26. So what do you get? Think about it. It has to be between 10 and 4, and you'll end up with an answer somewhere in the middle. It's actually 8.76 or 8.8%. Now that's an example of calculating an average again. It's called a weighted average. So the 3 steps are critical. Cost each one, value each one, and then work out a weighted average. Now what I'm going to do, right, I've spoken for quite a while, so I'm going to give you a little poll question, and I'm going to ask you to have a go at this. And I'll give you about, say 7 or 8 minutes, see if you're okay with this. Um, so this question is going to be asking you very similar to that question. I just changed a couple of things, harmless things, but I want you to have a go and see could you identify the weighted average cost of capital. So again, this time there's 20 million shares. You got the share price of €2 costing 12%, 8 million preference shares, price €1 costing 8%, 5 million loan, 6% interest rate, tax at 20. So again, take your time, but have a go for the crack, right? Nothing to lose here. But of the 30 in the group there, I'll stop it when I get 15 or 16 in.
Eu não vou responder que eu não sei, meu filho. Eu vou estudar.
off the poll question now in a minute, which are going well, in fairness, and I'll bring you through the solution. I'll just give you another minute because there's about 19, 20 fair dues. Good for trying the question. Okay, I'll end the polling now, and it's again, most of you are getting it right, which is great. 21 out of 30 had a go anyway, at least that's good. I'll just maybe show you, I'll share the poll with you, and I'll highlight the result. The highest was correct. 10.7% is the appropriate answer. I'll share the result with you. And you can see the general situation there. So most of you are getting it right, but let me just bring you through the solution. I'll do this on a document camera or something. Make sure you're okay with this. I'll stop the share and I'll bring you through the solution on a document camera, and then we'll take a break if that's okay. This is what it looks like, right? I just wrote down a couple of pieces of information. The question talked about 20 million shares priced at €2, and you're given the cost at 12%. 8 million shares preference with a price of €1, and you're given a cost of 8%. And then you had an old bank loan of 5 million. The interest rate was 6%. The tax rate was 20%. So I kind of used the similar format as the previous question. The question we're trying to figure out here is we're trying to figure out the WACC. That's our problem here. But anyway, to get the cost of the bank loan, take your old 6%. If there was no tax in the world, that would be the cost. And for you and me, it would be the cost. But for a company, they can write off the interest as a deductible item. So 1 minus 0.2 there is the actual 1 minus the tax rate in decimal form, 0.8 by 6, 4.8%. So now I have the cost of the loan after tax, I have the cost of the preference share given to me in the question, and I have the cost of the equity at 12%. I just need to figure out what is called the market values. So if I can get the market value of each one of the different forms of finance, then I'll be in a position to calculate the weighted average cost of capital. So for equity, the market value is simply the number of shares by the share price. I'm sure you're okay with 20 by 2, which is a 40 million score. So for equity, it's 40 million. That's the market value. If I do it for the preference share, same old crack. Number of shares, 8 million by €1, and you'll get an 8 million score. So I have worked out the market value of the equity at 40 million and the market value of the preference shares at 8 million. The old bank loan doesn't trade. Just take it that the size of the loan is the market value of the loan. The assumption being the company would pay back all 5 million. So I have everything I need. I have the 3 values and the 3 costs. The last part of the puzzle, I'm going to just cut to the chase. The WACC here is take the weight for equity, 40, multiply it by its cost, 12. Now I could write down 40 million euros and write down 12%, but I think it's easier to know the answer is obviously going to be a percentage. So just take them as physical numbers, 40 by 12. The next guy was the 8 million weight for the equity by an 8 cost. So 8 by 8. 8 is the weight and 8 is the cost. The answer will be in percentage. And the last character was the weight for the bank loan, which in this case is a 5 million weight. And you multiply that by the cost, 4.8. Again, you can write in percentage if you want, but I just work on this basis. And below the line is the sum of the weights 40 and 8 and 5, 13 and 40, 53. And I know it's millions and all that, but that's just the addition of the 40 and the 8 and the 5. If you had an old calculator and you input that stuff, you get something like 10.72 or 10.71 or something of that form. It's a percentage. The answer has to be a percentage because costs of capital are always in percentage form. So most of you got that right, which is great. And again, most of you had a go with the question, which is brilliant. What we're going to do when we come back, I'm going to take a break for about 15 minutes, but when we come back, I'm just going to bring you through questions like the questions you'll get in the exam coming forward, right? In about 3 or 4 weeks' time or 5 weeks' time, whatever it is, when we get to the end of the course, you'll have an exam. And it's an online exam. I know that I think they're giving you 3 hours for a 2-hour paper. You'll get more information on this later on. But the idea anyway would be I would ask a major question where I'll ask you to calculate the weighted average cost of capital. And I'm going to show you questions like the question that will come up in the very near future. So we're going to look at page 13 in your notes. I'm going to start with that question 1 geared when we come back in about 15 minutes. We'll just do one question, maybe start you off on a second question. This week and next week, we'll just do a couple of examples until you're okay with this thing and you're comfortable with calculating what's called the weighted average cost of capital. And I'll show you where it's applied. We'll show you where it's used in a business context. So take a break if you're okay with this. Have an old coffee or something. We'll come back and we'll have an old chat. If you want to ask me questions or unmute your mic, please do. No problem. Or if you want to put something in the chat area, they're more than welcome. So take a break for 15 minutes. We'll come back and do some more work. Chat you soon.
algumas coisas, Andy. Eu vou estar terminando minha faculdade agora, a gente gravita bastante, né? E aí eu termino já o curso, eu começo a trabalhar, junto meu dinheiro, vou fazendo um galpão lá, um galpão assim, e vou ligar, entendeu? E vou ganhar algum dinheiro, fazer alguma coisa, entendeu? Minha casa tá ficando boa, não sei se eu te mostrei. Pois é. Se você quiser voltar pra lá também comigo, se você não tiver sua casa ainda, você pode morar no meu barracão. Tem que ter cabeça, meu irmão, porque. É, mas não fala isso pra ninguém que eu tô te falando, não. A gente não sabe ainda, né? Se nós comprar, aí é outra coisa, né? Hã? Em 3 anos? Não, não daria não. Tô falando em 3 anos. Eu tô falando que a minha parte eu pago, entendeu? Agora não dá pra me pagar, tipo assim, se alguém precisar de pagar, não dá pra me pagar a outra parte, entendeu? Igual a minha mãe. Aí tem que ver certinho pra fazer as coisas certas, porque aí, tipo assim, não dá pra me pagar mais que eu vou pagar, entendeu? Porque é coisa séria, 500 mil é muito dinheiro. 500 mil? 500 mil dá 100 mil, 100 mil euros. É, quase 100 mil. Dá uns 80 mil euros, 87 mil. Dá uns 87 mil. É muito dinheiro, viu? É, eu não sei quanto que tá o euro. Ah, 6,5, pensei que tava 5 euros. 5 reais. É, mas isso é agora, né? Mas faça, por exemplo, faça se tivesse caído pra 5, por exemplo. Entendeu? Tem sempre pouco. Vai cair então, tem que estar pronto pra cair. É, 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 é. Tá. Então, nós vamos conversando, falar com a tia. Liga lá, conversa com ela também. É? Como se diz? É um empreendimento, né? Nós temos que ter cabeça assim, pra nós não fazer os trem certinho, né? É. Fazer certinho, tipo assim, organizar, porque se a gente começar uma coisa que a gente dá conta também, não adianta. Não, mas pensa bem, mil euros você Não, mas lá não aluga assim não, hein? Lá seria tipo assim, a gente vê como é que tá o estado, a gente colocar umas vacas, entendeu? Ah, eu acho que não arruma gente pra tá morando lá pra gente, entendeu? Baratinho. Lá na roça, se pagar tudo com dinheirinho, eles estão na conta. Não, eu falo pagar dinheirinho, não é pagar com coisa não. Coisa de 100, 200 reais, entendeu? E meu pai pode ficar indo lá direto também pra mim, entendeu? Minha tia, meu tio cansa. É tipo assim, nós temos que dar uma olhada como é que tá a casa, entendeu? Aí eu acho que caiu não. Será? Quando eu fui lá não tinha caído não. Quando eu fui lá em 2006 não tinha caído não. Você foi lá? Aonde? Onde você foi lá? Não foi não, Zé? Não, mas eu fui lá, ué. Eu cheguei lá com o carro. Eu fui lá com o carro do meu pai. Você acredita? Você acredita? Eu fui lá com o Monza do meu pai. É não, lá deve estar pedra. Se tivesse, mesmo se tiver caído do telhado, a gente, isso é baratinho pra plantar, entendeu? Não, a gente não precisa de aplicar dinheiro só pro doutor na conta pra gente não. A gente só tem que arrumar lá pro povo viver, entendeu? Aplicar dinheiro é pra pagar. Pra pagar ela e pra fazer o que quiser. Você faz sua casona lá, sua mansão. Do jeito que você quiser. Entendeu? Ali tem um lugar bom de fazer uma mansão, vocês imaginam. Tem. Tem vários ali. Tem vários lugares ali. É, se for querer morar muito perto disso, você lembra onde era a nossa roça de fumo? Pois ali dá pra fazer uma casona, né? Que não fica tão perto da água que é perigoso encher, né? É. E também tem lá pra cima, tipo, você anda, sabe onde era o cochete antes de chegar em casa? Ali dá pra fazer umas casas boas também. Hã? Não, você pode fazer lá, eu faria lá embaixo. Plantava milho lá em cima, ó. Ah, sim. É, ali dá também fazer. Só que a água ali fica difícil, viu? A da água ali é difícil. Ixi, eu acho difícil. É caro, entendeu? Fazer isso aí.
Okay, so I hope you can follow what I did so far. We're almost at the very end of this first topic, and that's the major part of your exam for me. The story with the questions you'll see from here on in are just this idea as you read the question, identify the cost of each source, the amount of each source of finance based on market value, and then come up with one little number at the end, which will be the cost overall of all the finances. More importantly, it tells the company what it has to achieve on its investments. So it's really about trying to find what is the company's target rate of return? What should it achieve when it invests in projects? So it's a very important piece of information because our second topic is all about investment appraisal. We move into the area of actually making decisions about good and bad investments. You'll see.
Paul,
And
would
yeah,
you be able to put up past exam paper questions and answers on Moodle?
no problem. I can do that. Yeah, yeah. And I'm going to I'll do some revision with you as well. In the last week or two, we should be able to look at last 2019 paper and the 2018 paper. So I'll put up some questions if that's okay next week, and I'll put marking schemes, and you'll see how the marks are allocated and all that sort of stuff. I will. No problem, Katie. Okay. Okay, so I wanted to show you an example of a typical question, like one you'll get in the exam coming up in a little while. So I'll show you the very first question that you'll see in your notes there, and it relates to a company called Geared PLC. So what I have done is I've taken, these are all questions that were done in past papers essentially anyway, but question number one here, as I read the information, I'll just explain what's happening with the question. As I go through the information, you'll see how this works. So for you in an exam, you'll get a question where you will sort of, as you begin to read through it, you'll see different forms of finance. So this one is called Geared PLC, top of page 13, I think. It has issued ordinary share capital of 4 million shares. So I'd immediately write down that sort of information. I've highlighted what's important in the question. So we have what are called equity shares here, and there are 4 million of these guys. So you got 4 million shares in this company. I'd take note of that. And then I can see some kind of a price, and it says with a current market value of €3.25 per share cumulative of dividend. Now that's a bit of a problem in that you are given the price of the share, but it includes a dividend that's about to be paid out. When you see the word cumulative of dividend, it means a dividend must be due very soon to that shareholder. And there's 4 million of these guys. Then it tells me an annual dividend of 1 million is due for payment shortly. So I actually know the dividend that's about to be paid out to the shareholders. Now that 1 million, I'm sure you understand, is not per share. That's 1 million euros available for the 4 million shares out there. So you'd have to figure out what's that per share as such, the dividend per share. But over the last number of years, dividends in thousands of euros, this is not dividends per share now, these are the dividends for all of the shareholders, have been as follows. And you got a bit of historical information. And so I can see that, okay, dividends have not remained static. They've moved from 600,000, 680,000, all the way up to effectively 1 million. So your man on the right here is the current dividend about to be paid out. That's effectively 1 million, 1,000 thousands. That's effectively a million. So I'd have to work out the cost of the equity there. Now, the problem with that question, I'm sure you'll appreciate, I'll just bring that back up again. The problem with that question is I have to figure out, well, what is the dividend growth rate here? And also, what is the actual dividend per share here? And what's the price of the share ex dividends? There's a bit of grief there. That's as difficult as it gets. That's a lot of hassle there for the cost of equity. But you'll see in this question, there are only two forms of finance. So I'll go on to the next form of finance. The next form of finance is what's called a debenture, a borrowing facility. The company has 13 million, and again, this is a finance language, 13 million of €100 nominal debenture stock redeemable at par in 10 years. Now, that all simply means they borrowed 13 million, and so they have to hand it back in 10 years' time. And they're paying 8% interest on that 13 million. But it's just not borrowing from a bank, it's borrowing from individuals out there in the public. So people give them €100 and they get 8% of that 100. And people give them lots of €100. It turned out to be 13 million they took in. But they're all paying 8%. Every individual certificate, which is 100 in size, is paying 8%. Their current market value is €77.1 per cent. Again, this is weird, but it's just language of finance. So they're simply saying to you there that the current trading price is 77.10. 77.10. The percent there is just to reinforce the fact that the original price of the debenture was €100 nominal. It's just a style of quotation system. So they're at 77.1% of their original price of €100. They're at €77.1, same thing. Annual interest has just been paid. I highlighted that to indicate that this is X interest market price. So what I have there is the X interest market price at 77.10. And then you have what I call the corporation tax at 12.5%. Now, that is only relevant from the point of view of interest as tax deductible. And finally, we have the question, calculate the weighted average cost of capital. That's what you'll see in front of you. Now, if you got a question like this in the exam, you'd have the best part of a half an hour or so to answer it, 25 minutes anyway. So you really have to work on what's the cost of the equity and what's the value of the equity, what's the cost of the debenture, what's the value of the debenture. So maybe if I give you 10 minutes, even just to have a look at the cost of the equity here. See, could you work out, the problem here is you've got to work out a growth rate. It's like previous questions we've done, but it's as complex as they come for equity. And the same thing for this fella. This is a question like one you've done before, except I know the amount that was borrowed and I know that it's redeemable. That means, unfortunately, there's an internal rate of return involved here. But I'm going to do it, I'll split it in two. I'll do the equity first in about maybe 8 or 9 minutes or so. I'll have a look at the equity and then we'll have a look at the debenture. But maybe you'd have a go just for a few minutes. Again, don't panic if you can't do it. It's your first example question. But if you could have a go and see, can you identify what is the cost of the equity, or try and get some parts of it, and what is the market value of equity? And then if you have a little bit of time, you could have a look at the debenture. I will go through it slowly but surely. We're just going to do maybe one question today. We might get an introduction to a second question, or I might give you some homework for the crack. So anyway, see what you think, and please ask. Unmute your mic if you're having difficulty. But if you want to type something in the chat area, no problem as well. So I'll leave you for a few minutes, just for 10. See, can you come up with something here? If you're looking at my document camera, you can see the basic information there. What I've written down is 4 million shares, share price, including the dividend, some kind of history growing from 600 to a million effectively. And this is a formula that you can use. So that's the kind of stuff I tend to take note of. And then I have a debenture issue, 13 million borrowed, 8% coupon, trading at 77.10. That's X interest. Redeemable in 10 years, which is a pity because a lot of hassle. And the tax rate 12.5%. Unfortunately, if you're dealing with a redeemable debenture, you have to work out an internal rate of return, IRR, their internal rate of return. So I'm going to maybe just show you a little bit about the equity. Again, don't worry if it's not working for you, but it's a case of practicing questions. The trick with finance, anything to do with number crunching, whether it's financial accounting, management accounting, finance, taxation, any form of decision-making thing involving numbers, it's just practice. That's all it is. With a bit of practice, you get really good at it. But it does involve practicing, not auditing solutions, however. No point in taking down the solution without understanding the process. But if you have a go at it, it'll work. I'll show you now very slowly, just for the equity for a few minutes, see what you think with this one. So I'm going to share with you the overhead we had. And I'm going to bring you towards the solution to do with the equity. The opening line here, there's 4 million shares and there's 1 million cash as a dividend payout. So I need to figure out the dividend per share here. So all you got to do is take the money and split it 4 million ways. The most recent dividend, or the current dividend, the one that's about to be paid out, which is included in the price, is €1 million. And there's 4 million shares in the company. So all you do is put 1 million over 4 million. If you want a 1 over 4, or 0.25 of a euro. So they get about 25 cents each. So now I know the current dividend per share is 25 cents each. It's about to be paid the next couple of days. So that's the dividend per share. I need that. It's part of the formula. The next thing I'd do if I was working on this question is I'd say, okay, well, what's the actual current market price X dividend? If you know the price cumulative of dividend is 3.25, if you take away the 25 cents from the price, including the dividend, you'll get the price X dividend. So I have a little bit of an answer here of about €3. Let's just take away the actual dividend payout that's going to happen in a few days. That's why the share price is cumulative of dividend. Take it away and you get €3. You now have two parts of a three-part puzzle. The final part is the difficult part, and you've done this a few times, but it is a routine. And when I wrote down the information, I said years 1 to 6. The base year is year 1. So going from 6 years of information effectively is 5 years growth. And this is this little routine you've seen a few times, I think. But year 1 is the base year. Then getting from year 1 to year 2 was 1 year's growth, etc. So you got 5 years growth. That little guy over here is a power function. 1 plus g is 1 year's growth. 1 plus g to the power of 5 is 5 years growth. And what does it start with? Well, it was 600 at the beginning and ended up at 1 million, or 600,000 and ended up at 1 million. So all I did was I put the big number over the small number. I identified the overall growth pattern. So that's your 1 plus g to the power of 5. That's 5 years growth represented by a little formula. And then I put 1,000 over 600. You can, if you want, you can put 1 million over 600,000, same thing. But you'll end up with a growth of about, as you'd expect, 4 over 6, about 2/3, or about 0.66, 0.67. It's actually 0.66 recurring. It's a recurring decimal. It's an awkward number for a calculator. So it's grown by 2/3. It's grown by effectively about 66, 67%. And then, of course, this is now where you need to be very cute how to use your calculator. I need to get rid of the power of 5 and the 1 and find the value for g here. Really what I'm asking is what number multiplied by itself 5 times gives you 1.667. How you do that with a calculator is you get the expression on the left-hand side to the power of 1 over 5. It's called the reciprocal power. You want to get rid of the 5. Just get the whole thing to the power of 1 over 5. In maths, you can multiply powers. 5 by 1 over 5 is effectively 1. It becomes 1 plus g. So I'll get 1 plus g on the left, and I have to do the same thing to the right. I need to get this guy to the power of 1 over 5 with your scientific calculator. So I'll end up with 1 plus g on the left, and I'll end up with 1.667 to the power of 1 over 5, or if you prefer, 1 over 5 is in decimal form 0.2. So you know how to use your calculator, and this is critical, something you need to be comfortable with, and never borrow a calculator. Make sure you know the one you're using in the exam and stuff. So if you put in 1,000 over 600 in your calculator, you get an answer. Then you look for the y to the x function or the power function and put in 0.2 and execute, and you'll get an answer. And the answer will be 1.1076, approximately, to 4 decimal places. What does that mean? It means that if you multiply 1.1076 by itself, effectively 5 times, it becomes 1.667. So what is the growth factor? We'll take the 1 away on the left and the 1 away on the right, and G is 0.1076. So therefore, G is 0.1076, the price is €3, and the dividend is 25 cents, or if you want, 0.25 of a euro. So that was tricky. There's a lot of hassle in that, but I mean, we have done it a few times before, and there'll be a chunk of marks going for all of that because you've identified 3 little pieces in a puzzle. And this, of course, is given to you in the exam. So you just have to identify, well, what's next year's dividend? Put it over the price and add on the growth rate. And these are the little numbers that go in there, those guys. Be careful. If you put the dividend in cent, you must put the price in cent. If you put the price in euros, you must put the dividend in euros, like 0.25. I did it in cent format. So I just said, okay, well, what's next year's dividend? Well, it won't be 25 cents. It'll be about maybe 27, 28 cents. It grows by a bit. Next year's dividend is what's above the line. Divided by 300. Notice I used the same format for the dividend and the price. You'll get a calculation of this in your calculator. It'll be about 0.09 or something. You'll add it to 0.1076. You'll generate an answer with your calculator, and the calculator will come up with something, the best part of 20%. So you might have a slightly different answer here depending on the number of decimal places you go to, but you should be ending up with something like 19 or 20%. You get 19, 20, or 21, I'm happy. I'll give you full marks, no problem. Just approximately about 20% is the cost here. What are we doing? We're saying the company is paying out money, so it's costing them to keep these guys happy. Effectively, I'm comparing the payout to the price. And it's a cost of about 20% to keep these shareholders happy. So when you get the cost of the equity, just as I explained a few minutes ago, the next step, of course, is to work out the market value of the equity. And the market value of the equity will simply be the number of shares, 4 million, by the share price, €3. So you just take your old 4 million and multiply it by €3, 12 million. You're halfway through a question. It involves a bit of hassle there, but that is as difficult as it can possibly get for equity, because you have a lot of work to do here. You have to work out the dividend per share, you have to work out the price ex dividend, and you had to work out the growth rate. Sometimes you're given those variables. If you're not given them, there's a lot more marks going for it. If you're given them, there's a lot less marks. There's a lot of marks involved in that question there. You'd be talking about 6, 8 marks or something for all that effort there. Now, I'll give you a few minutes to have a look at the debenture, and I'll put up the solution, no problem, in a few minutes. But when you're looking at the debenture, it will be a different style, because debentures, redeemable debentures, unfortunately, there is no formula. You got a little formula here, which is kind of nice and handy. But if you don't have a formula, you need to identify the cash flows over the 10 years from the shareholder's point of view, the debenture holder's point of view, and then calculate an internal rate of return. Now, in case you've forgotten where this all came from, we did this a while ago, but you'll find it on page 10 of your document, of the handout. You'll be able to see an example of the full process of calculating what's called an internal rate of return. So we've done this a few times. So it takes a bit of time, but remember, you have a lot of time for this question. But what you could do, if you have a go at the debenture, you should be able to identify the cash flows and make a stab at calculating the IRR. I'll put it up in a few minutes. I'll give you just a few minutes to have a go with this, and I'll show you how it works. I'll put these overheads up on Moodle for you, so don't panic if you don't get to take everything down. But we're now going to look at what's called the debentures. I share with you the document camera to focus on the debenture issue for a minute or two, making sure you know how to find the cash flows. It's kind of critical that you can find the cash flows. So I'll just maybe share this with you. The information to do with the debenture, I'm finished with the equity. But the debenture, what do we know? It's like 13 million borrowed. That's kind of important later on. But what we do, like we do with the ordinary shares, we focus on the cost of one of them, and then we use the market valuation to reflect them all. So if you have what's called a redeemable debenture, in this case in 10 years' time, there's a template for how to work this out. Basically, what you've got to do is start with time period 0. And you always start with the market current price of the debenture. In this case, you'll be trying to find what's called the cash flow. What could the company do? It could go to the stock market and buy back the debenture for 77.10. It's traditional to put that in as a negative score. So 77.10 is the actual current market price of the debenture today on the stock exchange. The company could go to the market and buy it back for 77.10 now. If it were to do that, it would save the company having to pay interest for the next 10 years. It'd be the same amount of interest every year. And the interest, the interest involved is always the coupon rate by the nominal value. The nominal value is always 100. So you have this 100 score and you have an 8% score. So that's what's called the interest. So if there was no tax in the world, I'd be writing down €8. But you need to multiply interest by 1 minus the tax rate. So really what's happening here, it'll be €8, no problem, 8% of 100, but you multiply that by 1 minus 0.125, which will give you 7. You'll end up with €7. So that goes in for years 1 to 10. And then always at the end of 10 years, it will be over. And what goes in there is what's called the nominal value, €100. So that's the current market price. This is effectively a saving. If they buy it back today, they won't have to pay out 7 every year effectively for 10 consecutive years, and they won't have to pay out 100 at the end of the 10-year period. Now I'll put it on, it might be clearer because of my bad writing here. So if I put it on the overhead that you're familiar with here, this is what it looks like, slightly clearer, maybe visually clearer. But you will find that template for how to identify the cash flows on page 10 in your notes. And you also have several examples before this. But the most important thing is you can find the cash flows. You get 3 or 4 marks for that you can identify current market price, interest after tax. Notice that's 7, not 8, because it's 8 multiplied by 1 minus the tax rate. It turns out to be 7. Nominal value is always 100 for you. What do you have to do now? This is really boring and tedious, but you'll pick up a lot of marks here. What you have to do is discount those cash flows at a rate of your choice. You could discount them at 5% or 8% or 10% or whatever you want. If the answer turns out to be a positive NPV, you then go higher with the second rate and do it again. If you end up with a negative NPV the first time, you should go with a lower rate the second time and do it again. You need 2 NPVs at 2 discount rates. And then there's an interpolation formula. And that formula is available in the exam. And it's explained how to use it. And you've done it, I think, 3 or 4 times already. So this is a routine, but you will pick up a lot of marks because it takes a little bit of time to do it. But you're using your discount tables, your annuity and your present value tables. So let me just give you an answer to this. But if you have not done this, and don't worry, because you were given a short amount of time trying to get through the question fairly quickly. But if you worked it out here, if you were to work out what's called the internal rate of return here, you'll all get different answers, but they'll all be very close to 11%. I did it on Excel, so I kind of cheated. But at the end of the day, I got a score very close to 11% approximately. So you might get 10.8 or 10.9 or 11.1 or 11.2 or something like this. You'll end up, depending on what 2 discount rates you choose, and the 2 NPVs you calculate. And if you have forgotten how to do this, you need to focus on page 10 in your notes and shows you the full process. And if you haven't done it and you want to have a go, it's a good idea to have a go at this between now and next week. See if you're okay with calculating an IRR. It's slow, but it's a routine. When you get the cost in this example, you also need to get the market value. Let me explain what happens with the market value. So if you want to work out the market value for a question, you simply take the balance sheet figure, and that is 13 million. If you're looking at the question here, 13 million is the actual amount that they borrowed. And you simply multiply that by the price over 100. So you take the market value, sorry, you take the balance sheet figure, 13 million, and multiply it by the price over 100. Now, if I was to do that, price is 77.10. Divide that by 100, you get 0.771. So that's the balance sheet figure. And this is simply the price divided by 100, what you saw in the first hour. I didn't write it down. I'll write that on explicitly for you when I put it up on Moodle for you. But it's effectively 77.1 divided by 100, which is 0.771. And you'll end up with a market value of the equity. Now, again, there'll be about 20 marks going for this question. So you'd end up with marks for calculating market value, marks for calculating the cost for each of the different forms of finance. The last thing you'll do in this question is you'll work out the weighted average cost of capital. So what do we work? We worked cost of equity was 20% and it had a 12 valuation. And the cost of the debt was about 11% and it had a 10, approximately 10 million valuation. So that's all it is. The weight by the cost divided by the sum of the weights, that'll be the 12 and the 10.023. You'll end up with an answer. Obviously, the answer has to be between the 11 and the 20. It's kind of halfway. You'll end up with an answer of about 15 or so, 15, 16%. Now, I've given the last part of this quite quickly to you, but I'm just saying between now and next week, you should be well able to practice and see if you get an 11, something close to 11%. I'm happy if it's within 1% of it. I just need to see you identifying the cash flows, calculating two NPVs and picking up loads of marks for that. If you end up with the wrong answer at the end, it's not critical. The most important thing is I can see you identify the cash flows. You've got two NPVs and you made a good stab at calculating the IRR. What does it mean at the end? This company effectively, when it invests, it has to achieve about 16% return on its investments. That's what it means. So what I'd like you to do between now and next week, and I know I've done a lot quickly there at the end, but maybe practice to see, can you calculate the IRR by getting two NPVs and any two discount rates you want, like 5 and 10 or 8 and 12%, whatever you want to choose, just choose two rates. And I'd like you to have a go at question 2 on the same page. It's a different style. It's in a balance sheet format style. But between now and next week, if you could have a go at question 1 and make sure you're okay with what I have up there, and I'll put this up on Moodle for you. But you could have a go at question 2, and I will put up on Moodle the solution to question 2, but I will start with question 2 next week, and I'll bring you through the solutions to question 2, and we'll do maybe 2 more questions, just making sure you're okay with how to calculate these things. But if you want to ask a question, please do. If you want to unmute your mic, if there's anything you want to ask, or if you want to put something in the chat box. But we're kind of finished for today, if you're okay with this. We'll continue next week. I'll do question 2. You'll have a go at it maybe between now and next week. I'll do it in class with you next week, and we'll do it maybe questions 3, 4, 5, or something like this. Just making sure you have no problem with the question that will come up in the exam in a couple of weeks' time. So I'll talk to you next week unless you have a question. I'll wait a minute or 2 if you want to ask something. I'll check if there's anything in the chat box. So take her handy. Do a little bit of work. Not too much, just a little bit. And I will put up everything on Moodle for you. So you'll be able to check solutions for all the questions, hopefully. No queries? We're all good? Okay, we'll see you next week then, so. Take care. Let's shut it down now.